question has to do with an unqualified opinion. So here's an interesting situation. Lincoln CPA expresses an unqualified opinion on the current year financial statements of a public company called Kennedy Corporation. At the point in time after the unqualified opinion was rendered, it was determined that the treasurer for Kennedy Corporation had embezzled $5 million during the year. She wasn't a Brooklyn College graduate. Don't worry. So the client employed a treasurer who embezzled $5 million. Now Kennedy Corporation, they sued Lincoln CPA. They sued the CPA firm. They thought that the CPA firm should have discovered that the money had been embezzled. But they didn't find it. When we do an audit, are we going to check every transaction? No, we do a sample. We do a sample, and there's no way that you could check every transaction. So you do a sample, then if you think you find something unusual, then you increase the sample size, and you keep looking for more information. So they decide to sue the CPA firm. You're going to sue the CPA firm, they're like, I don't get it. The treasurer embezzled $5 million. You guys should have caught that. What is the defense? What is the defense that the CPA firm has? What is their argument? Because they think it's not their fault, but it's got to be, it can't just be, well, it's not our fault. It wasn't me.
They follow the standard
Kamika?
that they follow the, they do the audit according to the standard of
Yes, right?
Yes.
So the generally accepted audit standards. They did everything they were supposed to. They took a sample, they did follow the procedure, they did everything right, but they didn't cover the embezzlement.
And they would have the walking papers to show.
Right. Well, what Giselle is saying is that usually the auditors get blamed, and sometimes they should be blamed because historically what's happened, we've seen many situations where this occurred, they are in collusion with the client. That's how some of these big accounting firms got themselves into trouble. It wasn't because they didn't know, it's they knew, and they worked with the client to cover things up. To inflate earnings, for example, or to minimize expenses. They were involved. They weren't innocent bystanders. They knew. That's why the best friend of a CPA is a shredder. Let's see.
The answer is gas?
The answer is gas, yes.
That's a new one.
The paid preparer's area of the return must be completed by a tax return preparer if D. A situation exists where the individual was paid to prepare, assist in preparing or review the tax return. So that's D. So the paid preparer's area of the return must be completed by a tax return preparer if D. A situation exists, was paid to prepare. All right, the Securities Act of 1933. The purpose of the registration, the purpose of registration under the Securities Act of 1933 is to adequately disclose financial and other information upon which investors may determine the merits of securities. True or false? True. How many say false? How many say true? How many don't say? True. The answer is true. According to the Securities Act of 1933, the prospectus must be filed after an offer to sell. That's false. It's got to be before the offer to sell. Last time we talked about our client who sold their house. Does that sound familiar? How much did they sell the house for? $355,000? In year 15. So they lived there for 15 years. In year 15, they sold the house for $355,000. And we said that they had an adjusted basis, a cost basis. So we're talking about the basis. What is the basis? Cost. The cost basis was $75,000. He purchased a new home for $200,000. So the question is, what amount of the gain must he recognize on this transaction? So he sold the house after 15 years. He sold the house for $355,000. The cost basis was $75,000. So what's the amount of the gain? How much did he gain? 355 minus 75, which is $280,000. So $280,000, that's how much he gained. That's how much he made on the deal. Bought the house for $75,000, sold it for $355,000. He made $280,000. We're not talking about, we don't have any information here about whether you had to pay a realtor commission. We don't have that information. So, but this question says, now that's one way the question could be asked is what is the amount of the gain, which is $280,000. But there's a different question. You follow me? So one question is what is the amount of the gain? So the gain was $280,000. Now this question specifically says though, what amount of this gain of the $280,000 must be recognized? $30,000. So the Internal Revenue Code says that they must live at the premises for at least 2 years. Well, in this case, he's been there 15 years. 15 years. And it says that if you're not married, the amount of the gain that can be excluded is $250,000. So out of that $280,000, $250,000 can be excluded. That means that the amount that he must recognize is the $30,000. So another question might be, what is the amount that can be excluded, which is $250,000. So make sure you're reading the question carefully. And you know, first of all, you need to look at what information is provided and then what question is actually being asked. Is it, what is the amount of the gain? What is the amount that could be excluded? What is the amount that must be recognized? But let's look at another scenario here. The next client is married. Happily married. Now, our client purchased the home July 7th, year 1, and sells it on January 7th, year 3. So the first thing we're going to ask ourselves, is that 2 years? July 7th to January 7th. 18 months. Okay, so we're going to have to deal with that. the gain on the home is $300,000. So we said she's married. The question is, what amount of the gain can be excluded on this sale?
500.
Now, you might say 500,000. Anna, right? You might say 500,000. So the Internal Revenue Code says if you're single, you can exclude up to 250,000. If you're married, you could exclude up to 500,000. But Percy pointed out for us something important, which is
18 months.
they only lived there 18 months. So what we're going to have to do is prorate the amount that can be excluded. So 18 out of 24 months is 75%. So 75% of $500,000 is how much? 375,000? Is that right? Close.
What's 75% from 500?
So 75% of 500,000. So the amount that the Internal Revenue Code says we can exclude is 500,000. But we said, but they didn't live there 24 months. They only lived there 18 months, which is 75%. So the maximum that they could exclude is 375,000. So what is the maximum amount of the gain that can be excluded?
375.
You're going in circles here. So it can't be 500,000 because they didn't live there the full 24 months. But the IRS is trying to be reasonable. They said we could prorate the amount that's excluded. They said, okay, it's 18 months, not 24 months. It's not all or nothing. 18 is 75% of 24 months. We'll let you take 75%, potentially 75% of the 500,000, right? That could be excluded. So 75% of 500,000 is 375,000. The question says, what is the maximum amount of the gain she may exclude on this sale? Is it 500,000? Is it 375,000? Okay, so how many people say 500,000? Some people said 500,000. Change your mind now? Okay. So some people said 500,000. What about 375,000? And any other choices?
Neutral.
Undecided? So the amount that she may exclude on this sale, is not 500,000. It's not 375,000. Yes, because how could you exclude more than what you made? It could only be 300,000. Hello? Somebody! Is there somebody out there who hears? Coach! How much is the maximum amount you can exclude on this sale? You think the IRS is going to let you exclude $375,000? When your gain was only 300,000?
Maybe a little.
How many say yes? How many think it's okay to do that? How are you going to exclude more than the amount of your gain? Is it just me? It's just me, right?
Maybe another country.
Yes.
Come on, come on!
Good question.
So, in this situation, it's 300,000. Yes. The amount that she could exclude is less than the 500,000, and it's less than the prorated amount of 375,000. So we know that the gain was 300,000. The question is, what we need to determine, what we need to compute is whether or not, come on, you can do it. Yes, you can. What we're trying to determine is whether or not she could exclude the entire 300,000. So we don't know. We know the gain is 300,000, but we don't know. We're not really sure if the entire 300,000 could be excluded. So we do the computation, and we find out that 75% of 500,000 is 375,000. So the amount she could exclude would be the entire 300,000. Yes. Yes.
If we threw in the same scenario, married couple had, let's say, a vacation home. So they have two properties now within less than 24 months. Everything else
Let's
remains
not, I don't, they can't. Let's just, we'll talk about that later.
all right.
Let's just keep moving. All right. Did we talk about this? About, let's see, they received a dividend from a domestic corporation. We talked about that, right? We didn't talk about that in study unit 7. We said they had
25,000.
yeah, 25,000. What was the amount of their revenue?
350,000.
Yeah, okay, we talked about that.
2012.
So they had revenues of 350,000. They had a dividend that they received from a domestic corporation of 25,000. They donated $50,000 to a qualified charitable organization. But the question is, are they going to be able to deduct the entire $50,000? They donated the $50,000. They have proof. They have the canceled checks. They did donate $50,000, but the question is, how much are they going to be able to deduct? Well, we need to look at their total revenue, which we said was
375.
and we're going to subtract the operating expenses, which was what, 100,000. Now, remember when we talked about corporate taxable income? Remember when we talked about charitable donations? We said that there's a limit. There's a limit. What is the limit? 10%. So 10% is $27,500. What is the amount that they could deduct? $27,500. They're not going to be able to deduct the entire $50,000. Even though that's the amount they donated and they could prove it, they're not going to be able to deduct the entire amount. Best students ever.